Hi everyone, my name's PK. Here I have Mohamed Radwan, who's an accountant based here on the Gold Coast. In this episode, because tax season is coming up, or some of you might watch or listen to this later on, it will still be relevant for the following years. We're going to discuss how to minimize tax legally. Okay, we're not going to do any dodgy things, but we're going to go through a lot of subject matter. It might be a fairly long episode, but I promise you, hopefully I can keep up to this promise. I promise you, if you watch right till the end, there will be some advice. I shouldn't say advice, information here that will actually help you save tax, whether it's this year or in the following year. So there's going to be a clear return on investment for your attention in this episode. We're going to go through how to estimate your tax benefits yourself. Number one. Number two, we're going to go through top tax tips, things such as how to claim deductions, depreciation schedules, body corps, investment property records, repairs versus capital improvements, so many things actually. Number three, carrying on a business of letting rental properties and extra things that can be claimed. Number four, rental expenses that can't be claimed. Number five, calculating CGT, capital gains tax. Number six, claiming rental property losses or locked accumulated in trusts or companies. So we'll be covering those entity structures as well. And what I did was I posted in my Facebook group, Australian Property Mastery with PK, with more than 50,000 people. I asked for an accountant that could come on and share their information, their knowledge, their experience with us. And Mohammed very kindly put his hand up. So that's why I've got him on the episode today. And also, a lot of group members asked a whole lot of questions that they wanted me to ask Mohammed. So at the end of the session, perhaps for another 10 minutes, we'll go through those questions and answers a little bit detailed, and they may really resonate with you. So that's the background and context. I'm really looking forward to it. Welcome to the Oz Property Investment Mastery Podcast. My name's PK, and I help busy people build passive income by buying top 5% growth and cash flow property and build a portfolio using data without wasting months doing research, spending weekends at inspection or catching flights, or dropping $10,000 to $20,000 on buyer's agents every single time. So if you're confused, lack confidence, and just overwhelmed with all the information and marketing misinformation available online and don't know where to start, then this show is for you. Mohammed, thank you so much for your time. I'm very grateful that you've making time in this beautiful Gold Coast morning right here. And if you wouldn't mind just maybe taking us through a little bit of your background and sort of the business that you do.
All right, so it's Mohammed here. Hi, everyone. I've been working as a tax accountant since 2011. So it's almost 13, 14 years now. I've been looking after pretty much individual clients, small to medium-sized businesses. I'm based in the Gold Coast, so I guess automatically being one of the hotspot for investment properties. When I started my career was in Fairmont Surface Paradise in the Gold Coast, so I guess that's automatically gave me interest in investment properties and automatically gave me a clientele, investment property owners that just I gained experience from. So every single, as much as I give information to clients, but clients as well, from their complex situation and complex question, give me information and make sure I update my knowledge and always put me on my toe. There's always a new question that you don't know of that comes every now and then from clients, and you have to go and research it and tell the client, I'll get back to you, because it's getting a bit more complex, especially in investment properties. There's buying, selling, living in the property, moving out, renting the property for a few years, and then moving back into it, and then renting it again. There's always complex matters with investment properties, and I think it just it's an interest area I like. I'm a investment property owner myself. I've been accumulating now for a few years. I've been considering myself lucky getting into the property game a little bit earlier, I guess. And as you probably know, anyone who started in the investment journey a bit earlier done well out of it and think himself expert investor. So unfortunately, but I'm not an expert investor. I'm just good at being a tax accountant. I'm just lucky, I guess. Yeah.
Very humble as well. Brilliant, brilliant. Well, let's get into it. The first topic was, buying investment property and estimating your tax benefits. So it's always good to understand what tax savings you can get before you buy. Of
Yep.
course, probably not a good idea to buy just for tax benefits because, at least if you follow my school of thought, even if you're a high income earner, it's probably not good to lose $1 just to get 50 cents back, but it's good to understand those cash flows nonetheless
Yep.
going in. So I'm sure you get asked a lot about this from your investment property or property investment clients. How do you go about this?
So obviously, when you buy an investment property, it's either going to be a negatively geared or a positively geared, or could be positively geared, and then once you add the depreciation, it turns into a negatively geared, which is always the good scenario everyone want to be in. Not that much cash flow negative, but you're still getting some sort of tax benefit from the depreciation. So I'll try to be as simple as I can because this is a very common question I get for new property investors who just maybe sign a contract to buy a property and they're eager to know, now I bought the property, I want to know how much tax saving I get, because as bad as it sounds, there's lots of marketing out there from many companies are saying, buy a property, you get big tax saving, this is the only way to reduce your tax, which I don't think it's the case because it's not always this way. But it's a common question that I get for new investment property owners. So the first basic calculation is you need to add up your income, so rental income. Just every time you buy a property, you need to have this equation, either in Excel, even in a piece of paper. This is the projected rental income. So assuming it's 30,000, and then you start adding all your expenses that you're gonna incur against the income, which is interest, body corporate insurance, council rates, water, you name it, repairs, property management fees. Because of the current interest rate in the market, obviously there's lots of properties tending to be negatively geared, which is expected, I guess, with 6.5% or 7% interest rate now. So if your expenses, if going back to income, so if your income is 30,000 and your expenses is 40,000, that's putting you in a negative position of 10,000. So now once you know your bottom line, which is a loss of 10,000, you, as simple as that, you need to look at, all right, what tax bracket I'm in. If I'm in the high tax bracket, my income is above 180, or in a new from 1st of July would be 190, then automatically my tax saving is 47% of the 10,000 losses I made. So will be 4,700 estimate refund you'll be getting. If you are in a very low tax bracket, so 16% plus 2% Medicare, so you're looking at 18% from 1st of July, then your tax saving is only 18%. So if your loss is 10,000, you only get 1,800 as a refund. So your tax bracket and your income threshold is very important to know it first and do a rough estimate of income minus expenses, give you a loss or a positive figure. If it's a positive, then you'll have to pay tax based on your tax bracket as well. So if it's positive 10,000 and your tax bracket is 47%, you will end up paying 4,700 in tax. So it's something to consider. Sit with your accountant, and before you buy the property, not after you buy the property, and start see, is there any way I can do a bit tax saving if my property is very positively geared, before I buy more properties, to try to minimize my tax in a legal way. And there's ways you can do it by structuring into a different structure or something else. So this is just a basic on how to estimate a tax.
Okay, awesome. So it's great to start with the basics. Let's go into like maybe your 7 areas of top sort of areas where you can save tax, your top tips for saving tax over and above what you've obviously just established as the groundwork.
Yeah. I think after you calculate your tax benefit or tax liability from having a property, you normally need to see how can you legally kind of save tax. It's not really saving, but making sure you're not missing out on anything that you were not aware of, that you end up paying more tax than what you should. So that's the whole idea of a tax accountant, is to go to someone who will make sure every single possible item that you can claim it correctly, and also not just claim it and you end up getting into trouble with the ATO. Just claim it correctly, so that if you ever get checked with the ATO, everything is spot on, and then you claiming it correctly.
Got it.
So the main item that I get a lot questions from and mistakes from clients is repairs versus improvement. I think it's a very hot topic that lots of people get it wrong. People think I would go and spend 20 grand onto my property before the end of financial year so I can claim it all in tax, but it doesn't work like this. You need to, every item you're spending, you need to try to see what is the item do in the property. Is it improving the property? Let's say you're renovating the kitchen, or it's you just repairing or maintaining the house. Repairing is straightforward. You're repairing, doing some plumbing work, you're repairing some light, you're repairing some broken plasterboard that tenants damage, you repairing any problem happen in the house, you're just repairing it. You're not changing the whole, let's say roof as example, something hail damage, some small amount, you're repairing it. But then if you repairing something you can claim in full, replacement is something you have to depreciate, and every time every item you're replacing might have a different depreciation rate. And that's why a good accountant will be able to help you of this is a repair, this is a replacement. Speak to him, make sure you have invoices, make sure the invoice is clear what's like this job for, because lots of traders just write a quick invoice with an amount, but you need to make sure they have a detail of what exactly they done. Even if it's a big amount, it's $8,000, it doesn't matter how big it is, as long as it's a detailed description. I done painting, I done repairing this, I done fixing the handles for door handles, I done this. So itemize everything. So when it comes to a review, you're sitting on a strong position to be able to claim it. But then if it's just a $20,000 invoice without much description in it, it's tend to be a renovation most of the time. So making sure you clarifying what is a replacement renovation or what is a repair. Repair, you can claim straight away. Replacement is something you have to depreciate.
Got it.
Interest, claiming interest on the property. It's one of the big high risk area now with the ATO, that obviously with the higher interest, the more interest you're claiming, the more negative geared you'll be. The more negative geared you'll be, the more tax benefit, the more tax refund the ATO have to give you, the more high risk you'll be with the ATO. So as simple as that. The bigger your refund will be, the bigger risk you are with the ATO. So interest is an area that lots of people do mistakes in. I see in the industry. So when someone buy a investment property, any interest you incurred on the loan for buying this investment property is something you can claim. But what I see often is people go, my property, I bought it for 500,000. I borrowed 400,000. Now this property went up in value to 800,000. I need to cash out some equity to either go buy a very nice house using this increase in equity, or to buy more properties, which is more investment properties. So the first scenario, I'm gonna cash out 200,000, which unfortunately the banks allow you to do it. It's fortunately and unfortunately, it just makes things complex for us as an accountant. But it's fortunately because you can release equity to do more investment with it. So when someone releasing equity from an investment property to use it for personal use, like buying his own house or putting it as a deposit for his own house or going on a big holiday, this 200,000, 300,000 you release as equity, the interest you incurred on this money because you used it for personal use is non-deductible. So people tend, oh, my loan now is 700,000. I want to claim interest on the whole amount. No, because you took this money out and you use it for personal use. You maybe upgraded your own house or spend it on your own house. You spend it on a holiday. You cannot claim except the original 400,000 you borrowed to buy the property, not the release in equity. But scenario number two is someone release the equity, that's a smart scenario. Release the equity to maybe put it as a deposit for another 2 or 3 properties. This scenario, yes, you can still claim the interest on this loan because the money used to earn more accessible income or to buy more properties that will get you more accessible income. So this is the common mistake. So people need to be working out exactly the history of the loan.
Mm-hmm.
It gets a bit complex with an accountant because people refinance from one bank to another and cash out equity, but it's your responsibility as a client, if the ATO ever checked, to explain what happened. Because I often get a client or came from a different accountant, already refinanced his loan, and now the loan is 700,000. So I don't see the history. So automatically you ask the client, but if the client was not truthful with you, you just automatically claim interest on this 700,000, and you don't know what's the history of the loan. You normally ask, well, is there any change in history, especially when you can see the market value increasing and the loan is very high. But people need to be aware that this is a mistake and they need to keep their own records. And any money they borrowed for personal use is not tax deductible. Any money they borrowed for investment purposes, they can claim.
Cool.
So this is just very, very important.
Okay.
So this is in relation to the interest. Claiming borrowing expense. So everyone buy a property, these initial establishment fees, something like the loan establishment fees, title search fees, cost of preparing and filing mortgage documents, lender mortgage insurance. So all these initial costs that people could incur when they buy the property. So all these items, loan establishment fee, title search fee, cost of preparing mortgage, you can claim on as a depreciation on a straight line method for 5 years. People who don't know what's a straight line method, but you just claim it on 5 years.
Sure.
So if you spend $5,000, year 1 you claim 1,000, year 2 you claim 2,000, year 3 you claim 3,000. You claim it until the 5 years finish, just to keep it simple for people. So this is very important. Every document you receive or you sign on when you buying a property is very important. So keep record of it, bring it to the accountant, give him, this is what I spend. Know what you spend, because as you're probably aware, PK, when people signing a loan document or when they're buying a property, it's just too many documents they sign. They don't know what they're signing off. Normally, they could be borrowing 9, 10, but then the bank would be adding another 3 grand for like title search, and you end up getting a loan of 918, even though you wanted only to borrow 915. So people don't know what happened behind the scene, and if you don't know the detailed expenses that happen, ask your broker, ask your banker. I need a detail exactly where is this money went. Look at the settlement statement.
Yeah, I was just going to say the settlement statement has that detailed out oftentimes.
So there's a settlement statement that you get from your solicitor, but then there's also a settlement statement that the bank have that showing where the bank spent the money that they gave you. So still ask the broker, because there's lots of hidden costs that you're not aware of that happen that you can claim. A big item also in a settlement statement, while we mentioned this, is cancel rates that the seller paid, let's say a month before he sell, but it's for a 6 months time. And then when you're buying the property, you end up paying the cancel rate to the seller, which will be in this settlement statement. So bring the settlement statement with you to the accountant to make sure he's claiming everything correctly. So all these details in a settlement statement, as much as it's complex for you, a good accountant meant to be able to understand it and make sure you're claiming everything in a settlement statement. So I think this is with borrowing expense. A big question clients ask, which is now it's a major expense, is stamp duty. Can I claim stamp duty? The answer is not in the beginning. You need to still keep records of how much stamp duty you paid, because you can only claim it when you sell the property. It will be beneficiary to reduce your capital gain. So you paid 20 grand stamp duty, you paid 30 grand stamp duty. As much as the big amount and everyone would love to claim it straight away, but no, you cannot claim it. You can claim land tax. Now people who say Queensland as example increase the land value big times, and just recently everyone got a new land valuation. Everyone might have, just because of this increase in land valuation, even though they were under the threshold of paying land tax, now they're above the threshold of paying land tax. So yes, you can claim land tax, even though it's a tax, you can still claim it as a tax deduction against your rental income, which will just benefit you. So make sure if you receive a land tax bill, bring it to the accountant, and he will claim it for you. So this is just mainly the purchase cost. One of the big items that people ask, moving to another item, is depreciation schedule. Should I get a depreciation schedule? Should I not get a depreciation schedule? Why would I even claim it when I have to add it back at the end when I sell? And this is always just a common question people ask. So me personally, I believe it's very important to have a depreciation schedule, especially if you are going for the long term. So your plan is accumulate, you're not selling in 2 years' time. It's worth the investment. Let's say you're gonna sell after 10 years, and every year you're claiming a construction cost of $5,000 depreciation, which is 2.5% of the construction cost. You don't need to know how much is the construction cost. You just need to go to a good quantity surveyor who will be able to prepare the schedule for you, and he will do all the calculation for you. You don't need to know any calculation. That quantity surveyor will tell you year 1 how much you can claim, year 2 how much you can claim. And for me as an accountant, I will take the quantity surveyor report and I'll be able to put it into your tax return. And the reason I feel it's beneficial, because if every year I'm claiming $5,000 for 10 years, and I'm getting a tax benefit at today's value, which is the dollar now worth more, in 10 years' time, 5 times 10 is 50,000. Even though I have to add it back to my capital gain equation, first, I benefited from this money when the dollar was worth more now than 10 years from now. Second, when I add it back after 10 years, I get the 50% discount. So I only have to pay tax, not on the whole 50. When I sell, I pay tax on 25,000. So for me, it's still beneficiary, just in a simple terms. If you're gonna buy and sell within 1 or 2 years for any reason, it might not be as beneficiary. It's just making things complex. But if you're buying for the long term, it's definitely a good expense or deduction to have in your rental property, which is allowed in a legal way. The only thing that you need to be aware of with depreciation is second-hand item. So if you're going to buy an oven for your tenant or whatever for the property, don't buy a second-hand oven or don't buy a second-hand item, because the rules since 2017 does not allow you to claim secondhand item in your rental property. If you're gonna buy anything for the investment property, something got broken, air conditioner, just make sure you buy a new item. If it's not in a depreciation schedule already because you already done one, either send it to a quantity surveyor to add it to the schedule or send the invoice to the accountant, and the accountant should be able to depreciate it for you in your tax return. So you will also claim a decline in value. This is when you buy air conditioner, when you buy equipment, this is not like a straight deduction. When you buy a hot water system, when you buy anything that got damage in a property, which hot water system is a common thing to replace in properties, just you will be able to claim decline in value of the item based on the rate. Because the rate is complex, ATO have schedule on how much you can claim for hot water system, how much you can claim for aircon. If you want to dig deeper, you can research it, but the accountant should be able to know it and have access to the information. So this is just for depreciation schedule. Body corporate, which is just moving from depreciation.
Yep.
Obviously, everyone can claim body corporate. There's one area in body corporate, which is a bit funny area not everyone know of. If your building, for any reason, decided to raise funds to, let's say, change the whole driveway in your building or replace the whole building roof, ceiling or roof, this is classified as a capital item or improvement. Even though you might have to pay 10 grand to body corporate because they decided to raise fund to fix something in a building, which will benefit the whole building, you need to, or the accountant need to make sure he's not claiming this in full. He's depreciating the capital item, which don't just tell the accountant I spent 10 grand in body corporate. Make sure you bring, if it's a major amount suddenly increase in body corporate, make sure you bring the invoice to the accountant with detailed. Regardless, make sure you bring the invoices to the accountant, but it just detailing exactly what the body corporate spent on, because if the body corporate ever raised fund, they will have a detail on how much they raised and why they raised it. So this is an important area in body corporate. That's why I thought I would mention it. Not everyone know it. Everyone think I can claim the full amount of body corporate, but not all the time. Sometimes not, just to make things complex for people. I guess record keeping will be my kind of this is a basic deduction before I go record keeping, which is like claiming insurance, claiming property management fees, claiming repairs, which I already discussed in the top, council rates, water charges. So anything you spend on a rental property, there's something you can claim. Make sure you bring it to the accountant and he will tell you, is this something you should be claiming straight away or you should depreciate, or it's an expense you should be claiming against your capital gain. So anything you spend on a property, make sure you bring it to your accountant. There's nothing wrong with bringing him too much information and he will just filter. But it's better than having missing information. That's all. Yeah.
Brilliant. Brilliant. All right. Well, let's go to the next section, which is all about carrying on a business of letting rental properties. So, like, what are the extra things that we can claim with this view?
Yeah. So carrying on a business of letting rental properties, this is the area the ATO doesn't like, and it's a complex area because once you are on a business of letting rental properties, you're not just a property passive investor anymore. You start be eligible for lots of other areas and deductions that businesses are allowed to claim it. Investment property owner is not allowed to claim it, which is the easy example is travel expenses. So back in the days, investment property owners used to be able to claim travel. I used to have it a lot in the Gold Coast. I guess there was lots of people used to come to the Gold Coast to inspect their investment property.
Yeah.
But the ATO, obviously, because lots of people was misusing the system at the time, the ATO eliminated. No one can claim driving to inspect the property, no one can claim travel expense to inspect the property. But when you are a business, you're running on a business. So traveling for business purposes is tax deductible. While if you're just a passive investor and traveling, you cannot claim it. So travel is one of big example of what's the difference between a passive investment property plus a business of letting investment properties. ATO website pretty much saying, because it's very complex, apply for a tax ruling and we'll decide it if you are carrying on a business of letting investment property or not. Just to give you a basic background, but seek a tax advice about it because it's not as easy as you think. To be able to meet the criteria of carrying on a business of letting investment property, you need to show that you are running in a business, how active you are. You need to keep records of how many hours you're doing it. Is that your full-time job? Or you have already a full-time job and this is just a side hustle, you buying investment properties? Are you still using property managers or you are the one who managing all the properties yourself? So the more you're active in managing your investment properties, the more you tend to be going to a business. The number of investment properties as well make a difference. So example, if someone have 20 investment property, he doesn't have any other job, he doesn't even hire property managers, he's managing it himself. He go and organize repairers, he might even go and repair properties himself, he travel between states to do it. Even though it's complex, but this person will have 20 properties and have it as a full-time hassle or a business, this could be classified, if he meet all the requirements, could be classified as running on a business of letting investment properties, because the way he's doing it is a business in nature. Like it's tending to be a business. It's similar to I'm being a property manager for my own properties.
Got it. So then in that case, like you said, travel and maybe even car expenses, just anything that a business of that nature could,
can claim.
reasonably be entitled to claim, they could probably claim that.
Yeah. So that's the only benefit of doing it. Obviously, not everyone eligible for it. The ATO, pretty much because of the complexity, saying apply for a tax ruling. Applying for a tax ruling is not that complex. You can do it online. With the tax ruling, you're just stating, this is what I'm doing. Would I be running a business of investment property or not? And they will advise you. You can also make sure you speak to a tax accountant because it's a complex matter.
Good to know. So I reckon maybe if anyone's got more than 10 properties, then it's probably worth investigating into at some point.
Yep.
Cool. All right. Let's go into rental property deductions or rental expenses that you can't actually claim. And of course, this isn't going to save people tax, but it could save them a lot in audit, hassle, fees, and scrutiny from the ATO.
Yeah. So going back to the main point, travel, you cannot claim travel expenses to inspect your properties because people have this mentality. I had to drive to go to see the property. I had to fly to Townsville to see my property. I have to fly to Paris to buy a property or inspect a property. All this is not tax deductible. It's misconception out there, maybe because people used to claim it back in the day. So people have this mentality, I can do it. But no, you cannot claim it. Stamp duty, I think I mentioned this as well before. Interest expenses for private reasons, I think I also mentioned this before. It's always better if you're not sure of what to claim or what not to claim, go speak to your accountant. Tell him, bring everything, have a list of everything you spend on the property, and he will tell you, can you claim it or not? Is it capital in nature, we have to depreciate it? Is it a deduction straight away? Or is it you just leave it on a side, keep the records, so whenever you sell the property, you need this for capital gain reasons.
And then the last one, which is all around claiming rental property losses locked or accumulated in a trust or a company. How is this, if you've bought in a trust or a company, how is it different at tax time versus buying in a personal name?
I guess the biggest thing that people realize after they get the advice buying a trust for other reason, could be for borrowing purpose, could be for asset protection, which that's where you need to speak to the taxation lawyer or a lawyer who specializes in trust. Now I have a property in a trust. What's next? So it's easy to buy, but then you need to know what's your obligation of buying in a trust. Trust and a company is a separate entity than you. Need to do a separate tax return for them. This tax return, if you are running on a profit in a trust, this profit has to be distributed to either unit holder or beneficiary if you're a discretionary trust. But if you're running on a negative, maybe because of depreciation, or maybe the property is negatively geared, how to benefit from these losses? What's my options there when I have losses in my investment property when it's a trust, which is a common thing. Like people buy a trust, they come to me to do the tax return, and it could be even just $3,000 losses.
Yep.
$5,000 losses. But it's still a loss that you cannot utilize now. So you have two scenarios. One is the basic scenario that most of the salary and wage earner will have. Unfortunately, these losses will have to accumulate in a trust until you either property become positive and then you can start utilizing it, or you sell the property, you make a capital gain, and then utilizing these losses in a trust structure. If you reach a level of complexity that you have multiple trusts, this when a good accountant and planning with the accountant before the financial year ends, so now it's not even 30th of June. So if someone have multiple trusts, I advise to sit with the accountant, know what's the position of the trust before the end of financial year, not after. So if one trust is loss, one trust is profit, and the trust deed allow you to distribute to a related trust. So first you sit with the accountant, you look at the trust deed. Trust deed, does the trust deed allow you to distribute to a related trust, which is related to you? Then yes. Have you done something called family trust election? Yes. Then we'll explore the option of distributing from a positively geared trust to a negatively geared trust to utilize these losses. So this is the only way to utilize losses in a legal way. But because of the complexity of it, you need to invest the time and sit with an accountant, maybe even sit with a tax lawyer to plan it correctly, maybe even for the first year. So every year you know what to expect and you do it. You can do it yourself, invest money to consult with an accountant, invest time to sit with a tax lawyer to make sure the flow of income, positively geared property from a trust structure flowing to a negatively geared trust structure and utilizing these losses. So this is the only way to use the losses now. You
It's a
have to
really
have
good. It's a really good point, and I think not just at tax time, but even when you're setting up a trust, like you said, Mohammed, with either an accountant, tax lawyer, etc., making sure the deeds are done up correctly, so that when it does come time for you to do this, then it's a very smooth process. So it's really good to know these things, right off the top.
Yeah. It's a complex matter. So this obviously not a tax advice. So make sure you sit with your accountant. All what I said is not a tax advice because everyone have a different scenario. So you need to sit with your accountant to discuss it. But it's a hot area that now with high interest rate, lots of properties are negatively geared because of interest rate, and lots of people feeling, I'm putting all this money and I'm not getting any benefit.
Yeah.
So we need to see how can you utilize the losses by planning it correctly. So this is
Sure.
just claiming losses.
And it's very interesting, even though interest rates are relatively high at the moment, still, I think almost half or the majority of investment properties nationwide are actually positively geared because every year the rents rise. So those who have bought properties in, years gone by, the rents have risen so much that, on balance, the average property investor is still getting positive cash flow.
Yep.
And so I think people should see, and not be sort of myopic or actually see well into the future of what their cash flow profile could become like, and then accordingly, set up the right structures or, have the right conversations at tax time and just have that foresight. I think
Yep.
that's very important. All right, well, before finishing the session, I did want to read out maybe half a dozen or so questions that our Facebook members wanted me to ask you, Mohammed, and we can go through these very quickly if you don't mind. Or
Yeah.
if you feel that you're not the best person to answer them because they're actually meant for a mortgage broker or something, you can say the same too. Well, the first one is Alex is asking, can I or how do I bring deductions forward to this financial year? For obvious reasons, maybe the income is higher in this year and he wants to have more deductions. He's specifically talking about whether you can prepay interest. Interest is obviously, well, basically the biggest deduction that you can have for investment property. Or what about insurance as well? So is there any way to do that?
So insurance, if it's an annual insurance policy and you paid it before 30th of June, you can claim it. So this is straightforward, easy, as long as you, like if you're paying annually, you can pay the insurance policy and you can claim it in full. Interest, unfortunately, interest, you can only claim it when it's incurred. So if the bank charging you interest on a monthly basis and you pay 12 months worth of interest, this is when you can claim it. But you cannot tell the bank, I'm going to pay you interest in advance. Don't think bank take it. It's you paying the loan, the mortgage, not the interest in advance. But even if you could, for any reason that I'm not aware of with banks, you cannot claim it as a tax deduction because it's belong to the next year interest. So it's when it's incurred. So this is for the interest. Bringing forward any other deductions, if council rates, let's say, came in June and you paid it, you claim it in June. Obviously, if you paid in July, you will push it to the next financial year. So you claim it when you actually spend the money. So that's just, yeah, just any expenses you have related to the property that it's overdue, you've just been putting it too hard to do basket, just make sure you pay it before the financial year.
Got it. Cool. Next one is Agam is asking for basically business owners, business owners, typically small business owners, let's say, they try to they try to reduce tax. And that means that they, on their books, they try to obviously legally try to inflate as much as possible their expenses and reduce their income, meaning that their net earnings is as small as possible for tax reasons. This obviously works contradictory in terms of then the mortgage or the borrowing capacity that that business has, because the higher net earnings a business has, the higher the mortgage or the serviceability or borrowing capacity,
Yep.
that business has. So it's a bit of a contradictory or conflicting type objectives for small business owners. But Agam here is asking, what tips can perhaps you give to business owners to make their financials look better? Like, for example, is there any fancy things with accrual accounting where they can reduce tax?
So obviously, with deductions and businesses, everyone try to see what they can write off before the end of financial year to minimize tax, which is always sometimes conflict with borrowing capacity. So I think my advice to this is, let's say you decided to buy a machinery for your business to, let's say, spend $20,000, and at the time the tax law allow you to claim it. It's not clear currently with with the current tax law, but assuming you can claim $20,000 worth of deduction as an instant write-off, normally in the accountant books, he have to clarify that this is an instant write-off depreciation and it's a one-off transaction. My understanding, when by working with mortgage broker, obviously it's a bank and mortgage broker area, that the normally mortgage brokers can add back this depreciation or instant write-off, that the transaction that happened as a one-off, banks normally sometimes can add it back. So any other expense that you spend that's one-off, make sure you highlight it and tell the broker this is a one-off. Make sure the accountant highlight it into a different account when he putting the set of financials. So he can put, this is a one-off transaction. So let's say I decided to spend on education expenses for my staff this year before the end of financial year to reduce my bottom profit. But it's not a regular item I will have in my profit and loss every year. So make sure you highlight it, give an explanation to the broker. This is not a regular expense. Some brokers and some banks happy to add it back. So speak to the finance broker about it. But this is kind of the tricks, and I see by working with brokers, that's what they do, is digging deeper into your list of expenses,
Yeah.
and knowing what's a one-off and what's a regular expense. A
Got it.
one-off, that's something just reduce your profit this year, but it's not going to be in your profit and loss next year. So some banks are a bit flexible on trying to add it back. Speak to a finance broker about it, not me. This is not a finance advice.
Okay, no problem. Next one, we'll go through these quickly. Kamlesh is asking, if someone wants to transfer a property from their individual name to a trust structure for succession planning, like leaving it for kids, what's the best way of doing it? Is this something that you can give any information on, or is this outside your remit, Mohammed?
Just because this advice have many implications. So when you're transferring an asset from one name to another or from one entity to another, it have tax implication, which could be stamp duty involved, capital gain tax involved. So you need to be speaking to a team of 3 people. I'm assuming one is accountant, one is a state lawyer, and maybe a lawyer that will help you with the conveyancing, or a tax lawyer that will advise you on how to transfer the asset for estate planning reason. I don't think it's just an accountant will be able to help you with this advice. So you need to understand, sometimes when you planning for future, when you're trying to do a complex transaction, it's not a one-man solution. You go to the accountant, he will do his magic and will fix it for me. It doesn't work like this. It's capital gain involved, there's stamp duty involved, there's estate planning as well involved. So you need to speak to the right advisors in it.
Makes sense. Makes sense. That's good advice in itself. Next question is pay-as-you-go variation. David is asking, can you talk a little bit about what is PAYG variation and why is it good or bad?
Pay-as-you-go variation is pretty much you're legally asking the ATO, I want my benefit from having a negatively geared property early. I don't want it at the end of the year. It's good for people who have very tight cash flow and they need this money now. It's bad because sometimes when you're doing the variation, you don't estimate, because it's based on an estimate. So you go to the ATO, you tell them, I'm estimating my rental income to be this much. I'm estimating my rental expenses to be this much. I'm expecting a loss of $10,000. I'm in a higher tax bracket or the highest tax bracket, so I need $4,700 refund straight away. So you're filling the detail. The ATO will give you a letter, how much you can value your income by. You send this letter to the payroll department, and the payroll department will reduce the tax they take from your payslip or from your fortnightly or weekly salary by this amount, which is a percentage, which means that you will get more in your hand every pay cycle. But in tax time, you will end up not getting as much refund, or you will end up even being impayable, which that's what I see a lot with clients who do a variation. They do a variation during the year to help them with the cash flow, but it comes in tax time because their estimate in the variation they done is wrong. comes tax time, you end up being having a bill because the losses they expected in the variation was not as much as the physical losses you were putting in the tax return.
Right. I guess at the end of the day, it all balances out to net zero.
It's the same.
It's just a timing thing. So
It's a
yeah.
timing. It's just helping people getting cash now instead of at the end of the year. That's all.
Yeah, good to know. Here's another one from David. He's asking, how often should you and your accountant be in touch? Like, I'm assuming he's asking from the perspective of just a normal, like not business owner, just a normal property investor. Maybe they have one, two, three, four, five properties. Should you be in touch with with your accountant like a couple of months before financial year end, and then maybe just like a few times during that tax time process, or should there be more touch points through the year with your accountant? What's sort of best practice? What's leading practice here?
I think every time you're planning to buy a property, it's a very good start to start speaking to the accountant to make sure you understand the structure you'll be buying under, work with a lawyer and accountant. So for a start, make sure every time you're planning to buy, at least have a small phone call with the accountant just to try to pick his brain about what's the consequence of this big investment I'm about to buy into my tax return. Second, especially for people who have trust, before the end of financial year in June, now is the best time to work out your trust distribution, or you have to work out your trust distribution before 30th of June. So make sure if you have positive year trust, have a meeting with the accountant. Don't leave it to the last day, so you can plan how you're gonna be distributing the profit, or how you're gonna be utilizing the losses. If you don't have trust, you're just a normal person with properties under your personal name, which is lots of investors out there, this structure. The more you have, like if you only have one, obviously when you go to an accountant, it costs money for every time you seek advice. So maybe it's not as important, but once you have 3, 4, you're multiplying, make sure you have your numbers before you go see the accountant. Like going to an accountant without the numbers, he's not going to be able to help you doing anything. It will just be a quick chat. Yeah, make sure you pay your rates, make sure you pay your insurance, but there's no physical. But if you want an estimate calculation of what's your tax position before the financial year end, come in with numbers. So come in prepared, have Excel sheet for each property. This is my income. This is my list of expenses. So the accountant would be able to advise you accordingly. The accountant wouldn't be able to know how much you spend without you telling him how much you spend and getting records for this. So this is just like, the more complex you get as an investment property owner with number of properties, the more regular you need to see your accountant. If it's just one property, it might be just as basic as just go see him at the end of the year when you're doing your tax return.
Got it. It's so useful. I mean, in my course, I really stress that people should understand all of these tax implications, the tax nuances. You know, I spend hours in these tools because I genuinely feel that property investors should know not as much as accountants because they're a specialized field, but a lot, you know, and so that way you can manage your accountant instead of going to the accountant and having a hapless face and, you know, just asking what next. You should be able to then ask the right questions, pointed questions to the accountant to make sure you're getting the most out of them. And I think just as you alluded to before as well, Mohammed, don't be scared to spend money on good accountants for good advice. I'm not saying to waste it. I'm not saying to like, you know, just go to H&R Block, nothing against H&R Block, by the way, and just like sit down for a consult for $200 an hour. I'm not saying, you know, just do it, you know, out of wasting money. But honestly speaking, I've spent, even in the last 18 months, more than $100,000, I think more than 120,000, my wife knows the exact number, on tax advice. And it saved me, of course, I'm a business owner, not just a property investor. It saved me more than $1 million in tax. So, you know, that's not a flex, but I'm just saying that to get that point across on how important it is to actually spend money, not just to make money, but to save money. And a good accountant has a clear return on their investment. or on their fees, I should say.
Yeah.
Mohammed, could you share, like, maybe people want to get in touch with you? And of course, I should also say I've not used Mohammed personally, but from this conversation seems to be very knowledgeable and professional and yeah, straight up good guy. So if people are inspired to get in touch, how can they do that?
So I created like a division from my main company, which is MAR Advisory, is my main chartered accounting firm. I created a division specialized for investment property owners, and I have a chartered accountant who will be mainly looking after investment property owner tax returns and advice. So this division is called IP Tax. So it's www.iptax.com.eu. So you can go to the website, you can call the office, you can book an appointment. I will try to have in the next couple of days a calculator, like an Excel sheet that you just plug in your income and expenses for property, and it will roughly estimate what's the tax benefit or tax liability from having this property. You need to know your income and expenses. So just to answer your, it's iptax.com.eu. So that's where people can find me.
Brilliant. Well, thank you so much for your time, Mohammed. I really appreciate it. It's not always the most fascinating of subject matters for folks, but I think from there's definitely return on their time, on their attention. If they get all this right, they'll save over the course of years potentially tens of thousands in extra dollars in tax just from the information that you very generously shared. So thank you very much.
Yeah, you're welcome. Thank you.
And thank you everyone for listening. And even if you're listening to this, after the end of the financial year, it's going to be useful for following tax years. Join the Facebook group where you can also ask for other professionals to come on, whoever you want, and then I can just try to bring you more and more value. My name's PK. Thank you for being part of the community, and I'll see you next time. Thanks very much.